We think women need to talk more openly about money because money really matters. It shouldn't be embarrassing or confusing. Join the conversation. We'll be discussing a whole range of topics which will help you get comfortable with your finances. Money Matters. Brought to you by AJ Bell.
Hello and welcome to this episode of the AJ Bell Money Matters podcast. I'm Laura and this week Danni and I are going to be talking all about risk.
Hello. Yes, it is something that we get asked about an awful lot, and there's been an awful lot of research done about whether women's attitude to risk is different to men's and what impact that then has on the gender investment gap.
And the first bit of research that really kick-started our Money Matters campaign, which if you're a regular listener, you'll know is all about getting you comfortable with money and helping you make the most of your finances. Well, that first bit of research revealed that almost half of women aren't comfortable with any investment losses at all. So a real kind of aversion to investment risk there.
Yeah, but I mean, we know no one wants to see their investment lose money, but over time, investing your money historically delivers better returns than cash. But even the warning that you could lose money is a barrier.
And we're going to be talking more about risk and how women think differently about risk with Laura Ann Moore from Mind, Money and Soul. She's a money and mindset coach and knows all about our relationship with money and what's at the base of many of our financial decisions. And regular listeners will remember that we've had Laura on the podcast before. So definitely go back and listen to that episode if you enjoy this one.
Yeah, she's absolutely fascinating. And just thinking about our past lives and our childhoods and how that's impacted our experiences with money, our relationship with money is just absolutely fascinating. But before we hear from that Laura, this Laura and I are going to chew over the big money news that's impacting your finances. And right now, it is all about Taylor Swift. Now, unfortunately, we're not going to hear a load of Taylor Swift music now. Are you a fan, Laura?
Such a fan. This is like my ideal podcast topic. So I will try and not geek out too much about this and stick to the actual topic that we're meant to be talking about.
Well, I was quite relieved that my kids decided that they weren't that interested in Taylor Swift. She's not cool enough for them.
What?
So, yes, I'm sorry.
Well, that is a dagger to the heart.
They wouldn't use the word cool either. Apparently, I'm not cool because of it. But look, I mean, she's phenomenal. The reasons that we're talking about her now is not about her wealth, though that is impressive, nor some of the conversations that have been taking place, some of the headlines we've seen over the past few weeks about her suitability as a role model to young women because she doesn't have kids. That is probably a whole other podcast, Laura.
Ugh, a depressing topic that we're still talking about successful women and whether they've got children or not, and that being a mark of success. Yes, yeah. I could rant about that for hours, but actually let's stick to the topic at hand.
And the reason that we're talking about her now, Laura, is because of her impact from her Eras tour that it had on our economy, particularly inflation.
I know, and isn't this great for data geeks like me who are also Taylor Swift fans that I got to spend a lot of time recently talking about Taylor Swift and data. It's like my ideal time. But yeah, this is the impact that Taylor Swift is having on our economy and crucially on inflation. So we had the latest inflation figures that came out recently, and they showed that the CPI measure of inflation, which is the one that we talk about the most, that had held at 2% for another month. Now, 2% is actually the target that the Bank of England has, and the fact that it's not going up and it's not at that kind of 11% level that we had seen recently, you would think would be cause of celebration. But actually, the expectation was that inflation was going to drop a little teeny tiny bit to 1.9%. So markets were a little disappointed that it hadn't dropped. Now, that might seem like an absolutely tiny difference, 1.9% to 2%. But actually, when we're at this level and we're talking about this kind of data that has a huge impact on kind of how the economy is doing, but also crucially when the next interest rate cut is going to come. That can represent quite a big difference. And one of the reasons thought to be behind the fact that inflation didn't fall is Taylor Swift. Not her spending personally, although there were lots of stories when she was doing her tours of the food orders she was putting in with kebab takeaways and things like that. It's more the money that the nation is spending, and also overseas fans are spending on going to her tours. So hotel prices and restaurant prices were one of the reasons that inflation remained at 2%. And it's thought that lots of spending from fans on hotels as they travel to different cities to see Taylor Swift, but also restaurants and bars if they're going out for a pre-gig meal or going for drinks afterwards, for example, are all thought to be reasons behind that inflation staying where it is.
Yeah, this is not the first time that this has happened, though. And I certainly remember talking on the radio just a couple of months ago about the potential impact that this tour would have on GDP. And tiny bounce expected. I think it was 0.01% this tour is expected to put towards GDP for the sort of month of June, July time, so around that quarter. And it was pointed out that Beyonce's tour last year had a substantial impact on inflation in Sweden. So, we're talking about the fact that Sweden last year, it had pretty high inflation, but it had a bit of a bounce because of Beyonce's tour. So she was on this massive tour, her first solo tour in 7 years, expected to gross around £2 billion by the time it finished. And Sweden last year had inflation of 9.7% in May. And that was because exactly the same thing was happening there. There were a lot of tourists coming in to watch the show in Sweden. There was a frenzy of demand for hotels. People were choosing to make, maybe a weekend out of it. So they were going out to bars and restaurants around the time and really making a big impact on inflation in Sweden, which at the time last year, 9.7% was not a number that they wanted to have. But it is likely to be incredibly short-lived from the first case, but also the side benefit, there's always swings and roundabouts when we talk about the economy, isn't it? Because on the one hand, inflation seems to have held firm in the UK, potentially went up slightly in Sweden, but also, that spend, that activity has had a boost for the economy.
Yeah, exactly. And I think there's actually a really interesting kind of real life example of something that everyone's been reading about a lot in the news, and people might be fans of Taylor Swift, the impact that has on investments as well and on stocks on the stock market. So, things like stock market names like Premier Inn owner Whitbread, pubs groups Wetherspoons, and also British Airways owner all have kind of factored in a boost to their earnings and to a potential boost, I should say, to their earnings and to spending on them, all from the Taylor Swift effect. And I think this is a really good way of those people that maybe are slightly newcomers to investors to kind of see a real world thing, spending by individuals or maybe even themselves, and then the impact that can have on companies that are listed on the stock market. Because Barclaycard came out with a really interesting report, and it basically analyzes loads of spending data of customers. And it came out with this estimation that there would be this nearly £1 billion boost to the economy purely from Taylor Swift, with average spending of about £850 per person. Now, that seems really high. And I mean, I went to one of the gigs, my tickets weren't expensive, and I live in London and went to a gig in London. And so my travel costs were very low. But if you think about, there were lots of people from America that came over because the ticket prices were cheaper in Europe and cheaper in the UK. Lots of people that came from Europe who couldn't perhaps get tickets in their hometown. If you think about how much they're then spending on hotels, restaurants, maybe even them making that into a bigger trip around their trip over for the gig. If you think about all of that spending on top of just the pure ticket price, then that can really add up and can have a direct benefit to some of those bigger companies that are running, you know, the hotels, the restaurants that are benefiting from that. But like you say, a short-term blip in a way. I mean, the tour does come back in August. So it could be that we see another small blip then, although there's fewer dates around then. But a kind of short-term spending dip rather than a prolonged spending boom.
So as well as going to see Taylor Swift, did you spend time making those little bracelets? Did you inhabit those craft stores?
I didn't, but that is probably a big spend, isn't it? I mean, some of the people there had so many bracelets they were handing out that was so cute and so lovely. But yeah, bracelet making kits. We haven't thought about the inflationary impact of that. I'll go away and report back on that.
Yeah, yes, please. Okay, it is time now for our guest interview this week. And as we said earlier, it's on a topic that we get asked about a lot. It is all about risk.
And we know that a lot of women don't feel empowered to invest because they don't feel like they know enough about it, or they don't feel comfortable with any kind of investment loss, even if that loss is short-lived. And there are never any guarantees, but we know that historically over time, investments tend to perform better than cash. And in fact, cash savings are often eroded over time by inflation, which we've just been talking about, and we know has been really high in recent years. But Laura Ann Moore from Mind, Money and Soul is a money and mindset coach who has worked with hundreds of women to help them understand their relationship with money. And she says our attitudes to risk are rooted in the past and in the different language used to talk about different kinds of investing.
And I wanted to start out with the fact that we've seen survey after survey, and including one that Money Matters did, saying that women are less likely to take risks with their money than with men. Why do you think that is?
I think it's quite a nuanced argument. It's a little bit chicken and egg, because it's like, is it that women are naturally less risky, or is it the messaging through society and, you know, the narratives that we've been pushed through the media that have made us that way? So I'm sure that you've heard of like the bit of research that was done where it looked at language in the media that was aimed at women and men and the difference. And it's like men from a very young age have been served words and phrases and images of people like them investing, and it's all like earning, building wealth, taking risk, you know, all of those kind of words. But when it comes to women, there's a lot of like cut back, splurge, save the pennies. So whether it's a mix of both, you know, just generally we're innately a bit more risk averse, but also we've been fed these messages. I think that kind of concoction has naturally just made women feel more, risk averse. And I think that has then an impact when we're constantly being told, be careful, investing's really risky. So it's like the two kind of don't add up. So I think the messaging in the media as we've grown up has definitely had a huge impact. It's probably one of the biggest things that I would say that has an impact on women investing and how they feel about risk.
Because when you're talking about language, I'm just thinking about other words like nurturing, caring, all those sort of things that are associated with women that we're told that we need to do in our lives. And that sort of all plays through to family as well, doesn't it? Looking after family. And does that play a part, that women are thinking more about their wealth, their money in terms of their wider family and not just about themselves?
Yeah, and I think that then that's a two-prong like sort of issue in the way of, one, you know, women in family settings are more likely to be the ones making decisions for the family, where you shop, where, you know, things that need, where you're spending money, the decisions like that. So naturally, on a wealth basis, they're thinking not just about themselves, they're thinking about the sort of, you know, the greater good of everybody involved. But also with this idea of women being more nurturing, more caring, what that also leans into is women more wanting to make an impact with their money. So, you know, in this instance, women wanting to use their money for good, wanting it to have a good impact in the world. And the issue with that is that again, we feel like, or we get told that when you're investing, if you're trying to make an impact, you kind of have to forego profit to make an impact. So it's this myth, I would say, that you have to pick, impact investing over making a profit, which doesn't have to be the case. But I think, again, it leans into this idea of women being nurturing, women wanting to have a good impact. So therefore being like, well, what I'm investing in, where is that going? What impact is that having? How is that impacting me? How is that impacting my family? So it's like looking at all of the things involved as opposed to just me, my money, and my profit.
So is there something to the fact that maybe it's less risk aversion and more risk awareness for women?
Yeah, I mean, I think that risk awareness is really important for everyone, should be for men as well, because if you're not risk aware, you're just going in blind and hoping for the best. But at the same time, especially when it comes to investing in the stock market, we're really aware there is risk involved and there's only so much you can control. So it's like, where do we draw the line as having all the information that we need to make us feel safe and secure to make a decision around our money, but then knowing that there is an element of taking a risk. And I think it's interesting because I have a lot of different female clients and female friends, and some of them that say, I'm really not very risky. Two people that would say that, their risk levels are still very different. So that element of like subjective risk tolerance understanding, because one person being like, oh, I'm not very risky, would make an extremely riskier decision than someone else. And I think this is why the education piece is so important, but really helping women to understand like, what impact is this risk having? What impact does it have not taking risk? Like there's all these different elements. And I think it is a combination of both risk aversion, like some people really just don't want to run any kind of risk and they're more likely, quote unquote, playing it safe. And then some are more like, as long as I'm aware of what my options are, I'm okay to kind of go into it and make some of these decisions. But there's a lot of research that shows women work better in groups, making decisions as a group, which is why like investing syndicates or chatting to your friends can be so great, because you're sharing, you're helping others feel confident, whereas men are more likely to kind of go into a decision and just kind of make it on their own and take that risk. But then you also have to look at all the other factors around, especially if we take into account like the gender pay gap, women may be on average having less disposable income to play with, to take that risk with. So there's a lot of different factors, and I think it's a combination for people of risk aversion and risk awareness.
And it's funny because when we talk about risk in terms of investing, I know certainly with my friends, they're all like, oh no, don't understand that, don't get that. And yet when you talk to them about maybe going to buy a house, which is often, the biggest thing that people spend their money on, that they're quite up for that, even though, house prices can go down as well as up.
Yeah, which I find it fascinating and so interesting, because if we think about it, especially in Britain, buying property is seen as such a normal thing. You just go to school, you get a job, you settle down and you buy a house. So it's so normalized, and the risks that come along with it either aren't taken into consideration in the same way, are viewed differently, or it's very much like, oh, well, it doesn't really matter because we'll have a house still, we'll have a roof over our heads. And there is an element of certain things making financial sense, certain things making emotional sense. And when it comes to property, it's like, it's this thing that has been passed down through generations. Whereas with investing in the stock market, it's only really become accessible for the everyday person quite recently, if we think about it in terms of, how long money has been around. So it's still quite new. And then if we put into play how long women have been able to be involved in that, women only being allowed to have bank accounts for the last 60, 70 years, it's still very new for us. Whereas property is just kind of been seen as this thing. And then if we look as well in like family structures, our mothers, grandmothers, great grandmothers, they are, they've modeled being risk averse. They've probably not been the one in charge of the finances. They've probably been the ones more looking after the families, if thinking about gender roles stereotypically. But that's been passed down. That's what's been modeled. So now things are changing massively, and property, to add to that, when you buy property, you usually have like a mortgage advisor or maybe someone there holding your hand. Whereas with investing in the stock market, it's a little bit more of a solo DIY journey, and maybe you're relying on friends, family, people that you know. So all it takes is a couple of horror stories for people to go, oh my God, that's too much. Whereas with property, it's like, that's been around for hundreds of years, and I think the way in which the risk is viewed is very different.
But of course, lots of women now are invested because they have workplace pensions. Why is it that the two things don't connect in a lot of women's minds?
I think that part of it is, when investing gets talked about out in the world, pensions, property, bonds, they're kind of like the three main ones that get discussed, but I don't think the wording and the messaging lends itself to being referred to as investing. It's more just like, do you have a pension? Have you bought a property? And therefore the connection isn't made. Whereas if you ask somebody about investing, do you invest? Their go-to is like, do I have a stocks and shares ISA, or do I buy stocks and shares? The go-to isn't necessarily, oh yes, I have a pension. And I've done this before when I've done workshops, and I'll say to people, raise your hands if you're an investor. Not many hands will go up. And I'll click to the next slide and I'll say, if you have a workplace pension, you're already an investor. And there's still a massive knowledge gap around a pension even being an investment. And if you read articles and, different financial literature online around pensions, they still massively use the word save for your retirement. Even though that money is being invested in the pension or through the pension scheme, it's still kind of seen as saving. And when you save for a house deposit, when you then use that house deposit, you're not investing in property. It's usually talked about you're buying property. So even just those little bits of language, I think, makes people not necessarily make the connection between the two.
That's interesting because I did some digging around and looked into the number of ISAs that were held by men and women. And women hold more ISAs. It's just that they've got cash ISAs. And we don't talk about the risk associated with holding cash because, over long term, cash value gets eroded, particularly when we've had inflation at the levels we've seen over the last few years.
Yeah. And that I think is massive because has such an impact, because we get told, or we have been told, that having cash is safe. It started off with having cash at home under your mattress, and then it turned into having savings in a bank account. And that's kind of where the buck stopped around safety. And it's like, we get informed about the risks of investing, be aware, you might lose your capital, this is at risk. But the risk of inflation is kind of then left out. So I feel like, especially people in my community, more of them understand the risks associated with investing, and maybe not on a deep level, but they just know there is risk, but they don't then necessarily understand the risk and the negative impact that inflation then has on your cash. And it feels like I'm in a safer position if I can see and hold my money. Whereas if you're investing, you're like, oh, I don't have as much control. And you can liken that to property as well, right? Because oh, okay, it's an investment, but at least I have the bricks and mortar. At least I'm living in something, even though the risk, like you might not be able to sell it. You might not be able to, get rid of it when you need to have access to that cash. So yeah, I think really starting to understand the risk that is associated with inflation makes you understand it's not always safer to have your money saved in cash.
And I know the FCA has been taking a good long look at this because they recognise the importance of diversity and inclusion, of helping deal with that gender investment gap. But, we have to have those risk warnings whenever we're talking about any kind of investment. And yet they are a barrier as well. What can be done?
Yeah, definitely. I agree that it kind of adds to the barrier to entry because people just see it, especially women in my community, and they're like, I kind of, read the opening statement when I went to open it, and it said risk is associated, and it just made me freak out. But I'm a massive believer that knowledge is power. The more that you can understand and the more that you can then put it into context of what you're doing, the more confidence it's going to give you to make those decisions. Now, obviously, you don't then have to go all in, invest your life savings. That's absolutely the last thing I tell anybody to do. But being able to start small and build it up and get the confidence of like, oh, okay, this is the risk. I'm able to look at my investment account and see it go up and down daily. But if I zoom out, I'm very aware that the trajectory is up, and also that I have more control. So if I need to rebalance my portfolio, or if I need to make some slight changes, I can do that. And I do think that one of the biggest things I've seen that have had an impact in my community is people, when they come to me to learn about investing and learn about the risks involved, I look like a lot of my audience. Most of my demographic is young females, and they are more likely to follow me and learn from me than perhaps, men or older people, purely because the relatability. They're like, if they see Laura, I'm a young female in Britain doing it. Well, if she can do it, I can do it. And it's having that relatability in someone that looks like you, I think is really important. But then also having the language broken down. The language around investing, I think, is so overcomplicated that it makes people either A, if they have a lower literacy level, or if they have just been conditioned to believe they have a lower literacy level, they're going to be like, this is not for me. I'm not able to understand, because you end up in a position where you're reading an article or a book, and if there's one sentence that has, one too many words you don't understand, it's overwhelm. I remember when I first started investing, I had like one side up was me learning about, reading the article, and the other side was like the dictionary, and I was having to translate. And then when you understand the words, it makes more sense in context of the sentence, and then you just realize, okay, it's just jargon. Like, and part of what I do is break that down and help people understand. But I do think getting that knowledge out there, getting people to understand, yes, there is risk, but risk doesn't have to be scary. Risk doesn't have to be extreme. It's more, there's a warning label. It's going to it's just how it is. And it's good that there's those warnings so that we can all understand what we're getting ourselves in for, but that we have the knowledge and the control to make more decisions around it and base it off of our own risk profile. But also add to that, people understanding like a time horizon. Somebody who's in their 20s is going to be able to naturally take a bit more risk than someone who's maybe getting started who's in their 50s. So it's not just what you're investing in, it's how long you have to invest, which is why I'm so, passionate about younger people starting and learning sooner. So it's all those little things that when you start to learn them and you read different studies or bits of research, you can then start to go, oh, okay, this isn't as scary as it's being made out to be.
Podcasts like yours, like ours, obviously it's aimed at trying to help people feel more financially confident. But I hear so often, particularly mums at the school gate, saying to me, why aren't we having this kind of financial education provided in schools? Because if we started early and everybody was coming to investing to their financial lives from the same place, that has to be a game changer.
Yeah, and I agree. I definitely think that there needs to be more financial education in the national curriculum. I guess the hard things that kind of plays into is whose shoulders does that fall on? Because I've been doing this for a couple of years now. I'm always learning, educating myself. And I also, I'm a financial coach, so I'm very aware of the line between guidance and advice. And this is something I'm learning and talking about all day, every day. And I'm very passionate about it, I have an interest in it. But if it falls down on teachers, they're having to learn something completely new. They have to be very aware of then what's being said. And then they have young children raising their hands. I have another question. Kids love asking why. So it's like, whose shoulders does this fall into? Do we then have to bring someone new into a school who is a financial advisor, planner, coach that can then take that on? Where is that funding coming from? So I agree that it should be more in schools, but I guess on a wider scale, it's like, how is that actually implemented? I think a great place to start as well would be more like university level. When people have started to make some money, they're old enough that perhaps they can start thinking about investing. They, maybe moved out of the parents' home to go to university, and universities can bring in people like myself and other financial educators to get on a level with people, especially as they've got their student loans. Because I know that that's a massive one. Kids come out of university with a bunch of debt or an overdraft. But if we could get in before that point, that's a win. So yeah, I agree. I think that the younger that we teach people, the better. But it's just finding the best way to do that. But that's why I love social media, because it's, it's accessible to all. A lot of kids now have phones with the internet, access to Instagram and TikTok. And yes, the downside to that is there are unfortunately people out there maybe not giving the best advice or not necessarily talking about the right things. And this is why it's really important to be aware of following people that are recommended, or, you know, I've done some work with the FCA before, so it's kind of like FCA approved, or people that are in similar communities. So there's a little bit, you know, around that, but being able to have access to the education online through podcasts, online influencers, that kind of thing, I think will definitely have a big impact for people feeling more confident in getting started.
I would imagine for a lot of women in particular, their entire lives have been led a certain way. Their relationship with money has already been very much embedded from, you know, the minute that they start getting that pocket money in their hands. So if there's one bit of advice, I use the word advice, if there's one sort of tip you could give women who are nervous about investing, what would it be?
I would say it definitely starts with having the confidence and putting aside the time to learn about it. Because a lot of the women, so I run a free investing masterclass where I talk about why we should be investing, the sort of common misconceptions, I debust some myths. And by the end of that hour, most of the women that join have learnt so much, and it's changed their entire opinion on investing. I think women generally have a certain opinion on investing. They feel like it's not for them. They feel like it's already for rich people. They feel like it's for old men. They feel like it's just not for them. So changing that narrative first is kind of the springboard to then go and learn about it. Because the thing about, you know, education is everybody learns in different ways. I'm very visual, so I like to see slides and I like to see graphs. Some people are, I can't remember all of them, you know, there's like kinesthetics, so it's doing. Some people like to listen to audiobooks. Some people like to read. So learning how you like to learn is important. But the step before that is just changing your view on what investing is and why it is so important. And once you kind of have that understanding, I think that lights the little fire inside of you to go, I want a slice of this pie, because that kind of needs to be there for you to then go and take any action anyway. Because if you don't feel motivated by it, regardless, and you don't understand why it's important, you're not going to spend a weekend or an evening reading a book on it, especially if you find it boring. So yeah, I would say learning, unlearning what you've been told about investing, really starting to understand why it's for you, and then you can go out and learn how to actually do it.
Laura Ann Moore there. You can find her on social media, on TikTok, Instagram, and via her website, mindmoneysoul.co.uk. But the big question, Danni, is, did she have a confession?
I know this is always your favourite part of the podcast, although this time maybe talking about Taylor Swift and all those data points might surpass it. But Laura's confession was a really interesting one, considering the subject we've just been talking about.
I'm going to do a financial confession, which is actually to do with investing, and it's very apt for this episode. And it is around, like, it's a risk that I took that so this is a lesson that I try and teach everybody. When I first started learning about investing, because I was in this space and I was like, I've got finfluencer friends and I know different financial advisors, and I jumped on a hype. I jumped on a investing hype that everyone was really excited about. And I thought, right, I feel quite confident around investing. And I had a strategy, which is invest for the next sort of 20 years, long, slow, boring. And I veered off track and I invested in something that in my gut I knew wasn't right. I was just doing it because everybody else was jumping on that train. And by that point, it was too late. The trend had come and gone. I was kind of on the other side of it. And I didn't actually really lose much money in the end. It was, I think I invested like £200. I think it went down to like £150. It wasn't a lot, but the lesson I learned was really not to just jump on a trend just because everybody else is doing it. Like having those conversations. If anything seems like a get rich quick scheme, if anything seems like, oh, you're going to suddenly make a load of money really quick, that's where I say red flag. It's probably not the case. And I learned that on a small scale a couple of years ago. And it was great. It was a really great way for me to kind of test my own risk, because I thought, I'm going to go for this. And then I was like, oh, that didn't feel good. And I was able to like assess after. But yeah, don't jump on any random trends or hypes, because you probably missed it by the time it's come around, and there's no such thing as get rich quick.
I think it's always good to hear that the experts on things aren't perfect and that they are fallible to some of these things as well and getting caught up in hype. But I guess the crucial part here is she wasn't losing a life-changing sum of money. She was putting a small amount in. And so whilst it's never good to lose money and where you never want to lose money, at least it wasn't a dramatic impact on her finances.
Yeah, absolutely. And understanding, I think, right from the beginning that it was a bit of hype. It was sort of that fear of missing out that had really propelled her into doing that, but just taking a tiny bit of money in order to explore that area. If you are investing, then you should be thinking very carefully and cautiously. And, that kind of move is very much, a bit of exploration. And you should be very careful when you're doing that kind of thing.
Okay, that is it for this episode of the Money Matters podcast. Thanks to all those who came along to our pensions webinar that we put on with our partner Noon, which aims to help women thrive in midlife. We've got another one coming up later this month, and it's actually beautifully tied in, Danni. It's on risk. So if you want to learn more about risk, how to assess your levels of risk and to really manage it with your investments, then keep your eyes peeled on our social media, which is at AJ Bell Money Matters, or of course sign up to our newsletter on the website ajbellmoneymatters.co.uk, and you will hear all about the webinars and any other events that we're doing in the future.
And our next episode is going to be all about how to teach your kids about money. Until then, thanks very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.